This is sort of a chat. I would invite you folks to join the chat as we go, because I know there's a lot of experience in the room. There's a lot of war stories, a lot of anecdotes around strategic investment in corporate venture. So let's sort of extend the discussion between the three of us to to the room. So thank you, John and Lindis, for joining us. I'll just say a few words to kick things off. Really from the angel investment perspective, I'm very keen to hear from the sort of corporate perspective from you guys. But clearly from an angel perspective, corporate venture, strategic investment, has been part of the sort of ecosystem that we're very interested in for a long period of time. Not just from an investment point of view, the capital aspect, but from the point of view of the capability that a strategic corporate brings to the table. And that capability is not just smart money. Smart money can be acquired from different sources, but it's to bring real assets to an investment. It could be a channel to market. It could be a complementary technology or solution set. That could be the customer. Early adopter, sort of leading customer, looking to put capital and their weight, their reputation behind an initiative. So clearly, from an angel investment point of view, it's got a feature in your capital strategy, at least in terms of your thinking, around capital strategy and the options that you might progress. And as Dave indicated, there's certainly far fewer barriers to corporate venture investment, strategic investment, with respect to the cross-border type interest than there are necessarily perhaps in a venture capital sense. So there's a lot of good reasons that angel lead investor directors should be considering this dimension. Corporate venture strategic investment is fairly well established in many geographies, certainly in the US, and folks will be familiar with the typical multinationals that have a deliberate capability and focus in this area. And from a tech perspective, they're the typical companies, Microsoft, VMware, and others. And they will invest capital in large numbers of companies to support those businesses. They'll also invest non-dilutive cash in those companies. So corporate venture, strategic investment, can have a non-dilutive element as well. So clearly a potentially very attractive option for angels and startup companies. Now we'll have a discussion around what motivates the corporate and what they're looking for. We'll have a discussion around the hooks, the issues, because money comes with a price, capability and partnership comes with commitment. So what are the trade-offs and what are the lessons learned, if you like, from those trade-offs? And clearly, this is also part of how you frame up your exit strategy. So is your corporate interest going to enhance or detract from your exit story? So there's a number of perspectives to take into this. New Zealand has been fairly average, poor in terms of corporate venture interest. There have been a number of efforts over the years. Spark Ventures clearly. With various mandates, have tried an approach. Vodafone have sort of gone down the path of perhaps more of a marketing approach, typically Vodafone to sort of strategic investment with a zone type accelerator, incubator type profile. And these things are starting to proliferate and grow further. A number of corporates are very consciously driving innovation and incubation. So, Lightning Lab and the team in Creative HQ working with corporates to help build that perspective on innovation and how to progress that. In the agri-tech sector, Sprout, I think Dean's here somewhere. Clearly there's a number of players there starting to take a corporate interest in startups. So from a fairly poor base, 10 years ago, we're now starting to see a lot more interest from a corporate perspective in New Zealand in startups. Which is giving us more options, more possibilities than simply looking for this as a path to exit offshore. And here we have two great examples of New Zealand corporates that are really opening up their perspective on the startup space, on an innovation space, And I'd invite, I'll start with you, John, to present your view of what drives Trade Me down this path, and how you engage with that market. How do you build a perspective of what's possible? So, initially, what's driving you? What's your motivation? And then what are you seeing in response to that? So we'll lead off with you, John. Thank you. And please introduce the company and yourself if you wish.
Sure.
Most of you know you.
Morena, Marcel, and bear with me, I really want to give this a go, and I'll say tēnā koutou, katoa, ko tongariro, taku maunga, ko manuatu, taku awa, ko ruakawa, moana, taku moana, ko McDonald, taku whānau, ko John, taku ingoa. Nō reira, tēnā koutou, tēnā koutou, tēnā koutou, katoa.
Yes.
And thanks heaps, Marcel, for the opportunity to front up here. I really appreciate it. And to go to your question around sort of what's driving Trade Me and driving our interest in this, and how do we think about the space, and how are we looking to engage. Over sort of super brief summary of where Trade Me's at, which is we're nearly 20 years old. These days we have around 600 people that work at Trade Me. We're publicly listed, have a market cap of around about $2 billion. We're not a startup anymore, but we're still growing and still doing our best to grow. And that growth really comes in three parts. The first part is there's still a lot of runway left in our core business, and that's really organic growth that we're driving. It's probably not so interesting to this group. Then the next is where we're looking to do new things that sit really closely alongside our current work that improves our offering for our existing customers. And so, and some of that we'll build ourselves, some of it's through partnerships, some of it's through investments or acquisitions. And so to put an example around that, what that means is, say our biggest revenue generating business these days is actually Trade Me Motors, helping private individuals and car dealers sell cars and helping people buy cars. And so when we look to expand our offering there through investment, an example would be a company called MotorWeb that we acquired a few years back, who do vehicle data and reports. And so we were able to accelerate them because of the relationships we had with all the car dealers, and we could put them in front of the car buying public, but also those vehicle data and reports helped to improve the offering that we could put forward. And that was a few years back now. It's about a $20 million acquisition. Or another example would be just a tiny thing, a thing called Viewing Tracker, which was for real estate agents who were renting houses, and it was basically kind of booking software for appointments, and that was more like a couple of $100,000. So big range there, and those, for us at least, have tended to be outright acquisitions because we look to integrate them quite closely in with our business and bring on the team and really look for the team also to lend their often quite unique skill sets and perspective to Trade Me. So in both those examples I mentioned, a few years old, and the founders/CEOs at the time still work within Trade Me and contribute a lot and bring a really refreshing perspective. So that's that second step of growth, is us trying to do new things that sit alongside really close alongside our existing operations. Then the final leg of growth is looking into the long term. We want to get involved in new things. We're pretty acutely aware of our own limitations, and so whilst some of those things will be organic and that we build ourselves, we have a bias really to looking to exciting companies and investing in them and taking a stake. And a couple of examples of that would be the one most recently that really was the catalyst to turning up here, which was ZEZ. So we took a $4 million stake in there at around about a $21 million valuation. And another example would be Harmony, the peer-to-peer lending site we went into. And what happens there really is that I describe it as a bit of a mix of art and science. And the science is that we do have, I think, good discipline in applying structured thought and filters really to what we're looking for. And so for us, it's businesses that are primarily focused on New Zealand. That our focus very much is on New Zealand, with a focus primarily on consumers, mostly an internet company. I can expand on what mostly means if that's interesting. And often what we do in some form, which is where we provide a platform or a marketplace or a venue to bring together usually consumers and another party to help them out with some kind of relationship or transaction. And so we'll do that, and out of that will come industries that we're interested, models, particular business models that we're interested in, and ultimately companies that we're interested. So that happens, but the art of it too is that New Zealand's a village, right? And so we end up having lots of conversations and talking with people and just getting excited about particular companies and particular teams as well. And I'd say, just looping back finally to the example that brought us here, ZEZ was very much a combination of those two things, where it came through in those filters, but we got to know the team, really loved them, and it was those two things that led to our investment.
Thanks, John. Lindis?
Marcel, thank you for the investment and bringing us down. And maybe I'll just give a bit of background on Z and why I'm here, or why I think I'm here. So in terms of Z, so we're an energy company. We don't think we're a fossil fuels company. The way that shows up for us is that we are only based in New Zealand. We only ever have an aspiration to be based in New Zealand. And one of the things that gets the Z team out of bed almost more than anything else is assisting New Zealand's energy transformation. Part of that is being responsible for that, not just responsible to New Zealand, our staff, our customers, but also our shareholders. So neither should we catastrophise about our future in terms of the role of EVs, but neither should we seek to resist that at all. In fact, I'd take the case if we tried to resist that, all of our good staff would leave. So when we look at the future of Z Energy and the energy in New Zealand more broadly, there's a few things that we believe that got us to the path of our investment in and partnership with Flick and also Mevo, the vehicle sharing company. The first thing that we believe is that the energy future globally will not show up the same way at the same time and the same everywhere globally. In fact, we think there will be different energy futures show up by city, by state, by country. And the days of the big hydrocarbon supply chains are well gone. And there will be many different instances of things showing up in both the transport and energy sector. So that points to something that's incredibly uncertain. And whenever I see certainty in people talking about the energy future globally, it's a good opportunity to probably stop listening, but wonder what they're basing that certainty on. And the other thing that we know, or we believe, we don't know, but we believe is that transition enabled by technology will cause an immense amount of customer angst and frustration, and that will be probably the biggest impediment to the uptake of new energies, whether it's electrons, hydrogen, or whatever else. Really good example of this. We've spent quite a lot of time, myself and my team, in Norway, where 1 in 2 new vehicles is an electric vehicle, so it's got the largest EV vehicle fleet outside of China. And Fortnum is the largest provider of charging stations in Norway. And this was, I think, about 18 months ago when we were meeting and talking with the Fortnum team. One of the statistics they were proud of that they showed us was it was a proportion of customers that called Fortnum's help desk as over the total number of charging events. They'd managed to halve that roughly from 20% to 10%. So what that meant is that 1 in every 10 recharging events for an EV resulted in the customer calling the provider. And when you dig down, why was that the case? Was I got less electricity than I thought? It didn't work. The hose was different to the one that was in my car, etc. So you had, and apparently that failure rate still exists for Fortnum today. And that's where I think the opportunity is for Z, and more generally for anyone who wants to participate in the energy transformation system. It's not necessarily in the science, is it hydrogen, is it EVs, because I don't think anyone can know, but if you are technology enabled with a rigorous and great focus and being informed about customers, that's how we will win in the future. So that's kind of what Z believes. The thing that we do know is that we're wholly unprepared for a future like that. So if you think of the oil industry, it's an absolutely curious beast, and it's stayed the same way for the last 100 years. We're not vertically integrated in terms we don't drill for oil, we only trade it, refine it, and sell it to customers. But we've got control over a supply chain, and all our business systems, our computer systems, our cash management is structured around 100% ownership of the time that we procure crude oil from somewhere in the Middle East through to selling it to a customer. It's about 120 days. And we actually the oil industry doesn't need anyone else to do that. So you've got this complete vertical integration where you frankly don't need to partner with anyone else. Sure, you've got to partner with shipping companies and banks. But that's not something that we can rely on in the future. And that's probably the two biggest realizations for me, myself and my team, was that the absolute rigorous focus on the customer and being technology enabled, and we've just got to give up kind of that ownership of the customer supply chain or value chain. And that's kind of spooky for people out of the oil industry who are kind of used to control, and an industry that's frankly stayed the same way for the last 100 years, in essence, in how value is generated. And that's when we got to, well, we could try and change ourselves, or we could do that by acquisition or partnership with other companies. And we decided to do both. So we, maybe a bit cart before horse, we recruited Scott Bishop, who's sitting in the corner here, as our Chief Innovation Officer. And rather than putting Scott and team on the outside of Z in some sort of subsidiary, we put him right in the middle of Z, in essence to cause as maximum disruption as was possible without causing any ill health or
on whose part?
Yeah, or too much consternation. So at least we've had that dissonance occurring inside the firm. And we had to do that, before we could start treating or engaging with outside companies. But it was once we had that ability to learn, I thought that was when we were ready to start engaging with the likes of the industries that are represented here. And so far that's represented by, we've invested almost $1 million in the car sharing company Mevo, and more recently the $45 million in investment in partnership with Flick. So that's a really long story and why we did what we did. And what's been revealed in those discussions and those transactions and partnerships so far is our absolute naivety about our startups and the angel community. And it's been good fun.
Yeah, thanks for the investment, by the way. I think what I'm getting a sense of here is, there's a deliberate approach, transformational aspect around energy, looking to the future. You've created a capability, within Z, to not just drive change internally, but to address the market. John, you've had the augment the business, and then also leaping perhaps further forward into complementary, supplementary opportunities. To what degree does that formal sort of, let's call it a disciplined approach drive the creation of opportunities? So how much are you creating a sort of pull force, and to what degree are opportunities coming to you? Because what I'm trying to do is sort of get a sense of how startups and angel investors sort of open up the engagement with strategic investors and then potentially acquirers like yourself, you mentioned New Zealand's a village, so you're hearing a lot of stuff. But on the other hand, also, Linda indicated that you're looking at some of these opportunities globally. So it's not just a New Zealand market play, despite the fact you're serving the New Zealand market, but that innovation, sort of call it a portfolio of opportunities, has got a sort of global perspective. So I'm just going to try and get a sense of how disciplined, and it may well be serendipity and timing ultimately gets the outcome, or it may just simply be heavily weighted towards a long-term relationship where over time the confidence builds. Just want to get a sense of that process. Linus, do you want to lead off?
Yes, I might have overplayed the kind of the strategic rigour and planning we bring to this. New Zealand is a village. But at the same time, the thing that matters most to us at Z is strategy. So is this a manifestation of our strategy or not? Then how we do it. We've got a lot more degrees of freedom, so whether it is a partnership or an investment. There is a process, but it really just sets the playing field and the framework, which is, you could all imagine what that would look like in terms of participation, market segment, and capital exposure. So it's very simple, anticipatable kind of rules. And then we get a hang of a lot of inbound. Post the Flick investment or even the Mevo investment, there's dozens of inbound over the course of the subsequent 2 weeks. So we don't actually go looking that much. But in both instances, it was serendipity because I think both entities had targeted each other, unbeknownst to each other as well.
Excellent. John?
So we do aim to get clear in our own minds both the industries and then the companies that we think would be a good fit for us, and then look to spool up a conversation with them and to take a very long-term view around that. And we'd like to do that more, especially because often it can be the best companies that are heads down, really busy, just doing a great job of what they're doing. But I think we also get lots and lots of inbound inquiry too. And I would encourage that, where my perspective would be that where a company can get clear on what kind of investor would be a good fit, that's a good start. And then just don't be a stranger. And so to use ZEZ as an example, the investment, the deal we did itself was pretty speedy, but one of the reasons for that was that we had built up a bit of a relationship over time. And so the way that came about was just effectively personal connections, and that was the chair of she's actually reaching out to me and saying, you got to meet this team. And so it's quite a big founding team, but there are 3 of them who are really, really central to it. And so I went and grabbed a coffee with them probably about the best part of a year ago. And I guess the strength of conversation since then is actually really quite strong. So I personally would have talked to them very frequently and fronted up to most of the board meetings for a chunk of them, just to be able to hopefully help out, but also hopefully understand where they headed. So when it came to that time where it might be that Trade Me should make an investment, we'd had a good run-up. We'd understood each other and trusted each other, and I think we're genuinely enthusiastic about each other. Before you get into the deal, which always involves some tension and some pain to get through, but we had sort of really good reservoirs of trust and good feeling to make that pretty easy.
And what would kill the process? What's the, what are the, in your experience, what are the really hot buttons around the process actually seeing its way through, John?
It's an interesting question, my opinion would be that advisors can add an enormous amount of value, but they can also screw things up. And so, I can think specifically of deals we've had that have fallen over, in my view, because of the role the advisors played. And then in one case, we picked it back up. It was actually a couple of years later with the company, and invested, and it worked out really well actually. So
The advisors still got their fees, do they, 2 years later?
I don't believe so. So you know, that's one thing I mentioned. The other is just you know, no one likes a surprise through the process. So the more that you can, one, have that good relationship and shared understanding, that'll solve for so many things. But then also just be careful around being sort of as early as you can and sharing expectations and thoughts and stuff. And I mean, we actually found that even with the ZEZ deal, where I guess we've done a few of these things, but not a huge number. You know, the ZEZ team are pretty new at it, and TradeMe's board has a couple of directors on it who are deep into the venture capital scene. So, and they had quite firm views on what terms should look like. We had our own views, and some advisors we've used, and ZEZ had some actually different views on terms. And I think that if we had not had the strength of relationship that we had going in, it's not at all clear to me that we would have got through that, but we did by virtue of that, and now that's all ancient history, and we're happy and, you know, just getting stuck into it.
I echo so strongly. I mean, advisors, I mean, we're advised in our normal corporate world by Goldman Sachs, and you can imagine, you know, with these four walls, love the Goldman Sachs team to bits, but they're not well placed to provide advice for these sort of transactions.
Yeah.
So, but that was mainly internal. I think I'd focus on both transactions or both relationships, Mevo and Flick. The thing that caused us to sustain quite challenging times in both those discussions and both those relationships was a shared view or commitment of why we were doing this. So in regards Mevo, a shared view of the future of mobility that we're absolutely crystal clear on, and both teams are committed to. And with Flick, you know, the future of energy transformation in New Zealand, when you've got a technology-enabled, customer-focused business. Because if you've got that shared commitment, you can, that's what you rely on when times get tough and when advisors do get in the way. Yeah. If you can't if you can't, I guess, verbalise that to your respective boards or teams very, very quickly and insightfully and compellingly, then you know it's not heading well, going well. But they're the things that's what matters above all, I think, that shared commitment to a future.
I think it's actually sort of a useful sort of context for just further comments from myself. I've been involved in a number of partnership strategic investors and corporate venture. And I can think of two that have gone extremely well and two that have gone extremely badly. So there's a success rate there that relates to, you know, sort of post-deal engagement, and that sort of plays to both parties. And, you know, the strategic investment that clearly went very well was Microsoft and Green Button, and they eventually acquired Green Button. And how do you establish, you know, enough sort of tension to create real value and commitment to give that partner, you know, pride of place, you know, and that opportunity is a fascinating dance. For Merlo Aero, our strategic investor was a customer, AirAsia, that turned out to be a massive liability, and spent, you know, 3 years exiting them from the cap table, because effectively they thought they were running the company, and the solution was going to be geared entirely around their preferences, would be damaging the company and paradoxically providing them with a much poorer service. So there's really, you know, as you go into that relationship, it's maintaining that alignment, but also having some mechanisms to create sort of the right sort of pressure. Vimeo investing in Wipster, you know, having an option over Wipster, that was also a poor outcome despite best intentions, and that's probably, you know, exemplifies the sort of the power of sponsorship. You know, having the sort of both the vision and the visionaries, you know, leading the relationship. Where in that case, the Vimeo sponsor, owner, champion, you know, left the company and then handed over to a successor who didn't give a, you know, rat's about the about that scenario. And and then stole our CTO. So there are really interesting sort of nuances around that where it's a valid capital strategy. You bring in material capability, but then you have to work at it, and I think that's just indicative of any sort of partnership. And just as with angel success ratios, we're sort of 1 in 10. We get the multiple. It's much the same with strategic capital. It's 1 in 10 that truly resonate and achieve their full potential, and there are others that for reasons that relate to both parties don't actually deliver on the promise. And I thought I'd just sort of end on with some comments from yourselves on you've engaged in the market, you've done a deal. Now, how do you ensure that that there's a win-win outcome? That vision is realised that got you there in the first place. So perhaps, John, you want to go first on that?
No, I think it's a good point, because often it's you do all that hard work for the deal, and it's really just the sprint to the start line, and you've then got to go beyond that. And I think that what we've learned, and we've also learned the hard way a little bit, was just to be sort of really clear and I'm not sure conservative is the right word, but to really be careful not to overset expectations in terms of genuinely what we can contribute. And the sort of the backstory there was Trade Me, really high audience, really high engagement, and earlier on we'd worked with companies, and the expectation they came with was that we could showcase them on Trade Me and their traffic would go boom, and that it would just be this massive sort of multiplier on them. And
so what's wrong with that expectation?
I mean, you jest, but almost, to a degree, we had that expectation as well. And what we learned, was two things. One is that, that comes at an opportunity cost, a real opportunity cost for us, but also, as is the case with most customers in most settings, when someone's come to Trade Me to do something, they want to buy, the stall or whatever. They don't want to be sheep-gated to this other thing that you're trying to put in front of them. So the effectiveness of our ability to do that, we found that was a real risk, that would be overcooked in their minds, not necessarily sometimes because of the enthusiasm that we talked about, or sometimes actually more just implicit. And so I think that we've been really clear in just outlaying what we've found to be historically true, and so to make sure that people come into that eyes wide open through that. Then I thought, Marcel, that term you used before was really appropriate and bang on, was just around sponsorship. And one of the things that we've done that found pretty effective is when we've taken this sort of circa 15% stake, we've asked to have a director on the board, and there are certainly motivations around that, and just getting good visibility into that company and being able to influence. But also then that person comes back and is within Trade Me, and you have a focal point of sponsorship and ownership. And I think without that, it would be too easy to be sort of kind of out of sight, out of mind if we're not careful. Yeah. And so that's just a practical mechanism we've found, I think, quite helpful.
So the Flick's an interesting one at this juncture. So, it's kind of 8 weeks, 10 weeks old.
Still love you.
Yeah, still love each other. And it's so very, very early stage. And we've both hit challenging periods. So Z yesterday just issued its second earnings downgrade for 12 months, which is absolutely abhorrent to the executive team at Z. Delivering upon our commitments matters. So we've got some real challenges and headwinds in our core business, or we've had for the last 6 months. We're still optimistic about the future. And at the same time, the electricity market has just gone batshit crazy, quite frankly. And it's incredibly challenging for the Flick team. So for me, actually going in with the expectation, well, that just crystallised something that I knew, but I'd kind of neglected, was that you've actually got two organisations with their own hopes, fears, aspirations, and you're trying to create value together. And we've just had the perfect storm in both organisations since we closed the investment. and the relationships have endured. But you should, just remind them we need to set ourselves up for, prospering, not necessarily under those circumstances, but recognising that there are two individual organisations that are dynamic, organic, and have got their own hopes, fears, and aspirations. So the structures, like the directorships do matter. Really clean transactions where you don't have, options lingering afterwards or ongoing commitments, absolutely important. But don't, overplay your hand in terms of what you can deliver, whether it's eyeballs to websites. They're not set up for success naturally, I think, these sort of things.
Yeah, I think that's a really good point. I mean, I'm conscious of time, and there's probably a couple of questions. Is there time for it?
One or two.
Yeah. Trevor?
And that was really interesting. But first of all, I should say I was the first external investor in Flick and on the board. I was the first external investor in Sharesies. But I've got some complaints about that. They're a great company. And I'm also invested in Mevo. So I'm more interested in the effect that corporates have on existing angel investors. Sharesies is a good example. And we're in Chatham House rules, so I think I can mention it. Sharesies came through the Lightning Lab accelerator. Kiwi Bank FinTech Accelerator, powered by Lightning Lab is the official title, but they came through that, and I championed them through that. I thought it was a great team. I mean, I really liked the idea. It was so simple, and the way they were going about the process of democratizing share ownership, it was very Kiwi. It was wonderful, right? And they attracted a lot of interest from a lot of non-angels. So even though the angels were championing them, money was coming in from non-angels. It was not a problem because companies need money. So the angels kind of got squeezed out from the first Lightning Lab raise. So come demo day, there was basically no funds for angels. So you had to fight to get a little bit in. So we managed to get a little bit in for Angel HQ, and I think First Cup Ventures from Ice Angels got some in as well. And Archangels, yeah. So it was a fight, though, wasn't it? Yeah. So there an angel-backed company, angels fighting to get a small share. First round comes around, and there was not so much interest because they were raising after the beta round, after the beta test, they raised some more money. So wasn't able to put quite a little bit more money in that time. But the angels weren't that keen because they'd been sort of snubbed first time round. So it was a bit more difficult. And then suddenly there's we're doing another raise. And we really want you back in again. Oh, that's great, we'll come back in. We're raising 5 million, but already 4 million's gone to Trade Me. So you can come in, but we're going to scale you back down to almost nothing. So from an angel perspective, angels back their companies. They'll come back again and again and again. I don't know if corporates do, because corporates have an agenda and they've got shareholders to look after. But angels come in and they'll support their companies through thick and thin. Some a bit stupid, like me, but they'll be there. They'll be there for the next round. Whereas the external investors, potentially the corporates, they have a strategy this month, and then next month it might change. So I'm just wondering what your thoughts are about getting involved with companies that are backed by angels, and what your thoughts about angel investors are, because obviously it's an interesting, for me being an angel investor and a very active angel investor, I want to see companies like Flick do well. And thank you very much. It was a very, very nice exit. And I want to see Sharesies do well because I think they're a great team and they're a great New Zealand story. I just wonder what your aspirations are for Sharesies in the future. Obviously it's you can't say here, but it'd be interesting to hear your thoughts. Thank you.
There was actually a lot of good questions in there, so
time's up, John. So
I'll have a crack at a few of them. If there's any that I leave off, either grab me afterwards or yell here. But I think one thing that you touched on there, that I think is super important, is that ongoing support. And I don't know if Mark Vivian's still in the room. I know yesterday we might have done a runner, but Mark and I both spoke at a different kind of investor event a couple of months back, and I had the pleasure of hearing him talk, and one of the things that he recounted in that was just the needing to stick with companies through the hard times. And that's something that prior to us embarking upon this, we stopped and thought about really deeply, because I think it's quite easy, either through naivety or through just a lack of commitment, for corporates to not do that. And I think that is that's a really poor outcome often for those companies. So, I mean, obviously, ZEZ was really recent, so we haven't been tested in that regard on that. With Harmony, I can't think of a subsequent raise we haven't participated in since we went in, would have been 3 or 4 years ago. So I think we've participated in every capital event since then. But notwithstanding that, I think your point's, it's a good point and it's well made. Mention that. On the sort of the getting squeezed out, I mean, to be honest, that's actually a bit of a illuminating perspective, and one that I wasn't sort of fully across, to be honest. Although, I mean, this is probably deeply unpopular in this room, but I'd say that's an angel perspective. I personally was an investor in that first round as well, and whilst I might just be sort of a newbie angel, I haven't really got into that space, but I brought my own cash, and I think I really did my best to help that company beyond that. So I'd hope that I'm not a drag, that's still, so my point being, there can be other investors who are not angel or don't wear that moniker, but who genuinely do support the company. I just mention on that. And then just super quickly, on the point around the other squeeze and then the latter round, that I think was just a tough thing. I'm not too sure how, and I guess it's probably more the responsibility of the ZEZ team in terms of how to manage that. But what the sense I got from you, hopefully though, was you know them well enough to know their good intentions, and to I'd ask you to cut them a bit of slack in that regard. So I think there's probably about 3 out of the 5 questions you asked, so I'll deal with the others later.
Yeah, just 2 things I'd say. When you talk about a company like Z or Trade Me, there is no such thing as Z or Trade Me. There's only individuals who make decisions. And I think it's really incumbent upon the companies, whether it's ZEZ or Flick like myself, to actually understand the individuals within Z or Flick or Trade Me that are making those decisions, and understanding why they're doing it, because it's very, very personal for them as well. I wouldn't underestimate how personal these sort of decisions are within corporates. It's not to say that they endure as long, but actually it's really important to understand the individuals behind the decisions, because otherwise you end up with kind of the whole false attribution era, like corporates are like this. Well, it's actually usually individuals, and the better you can understand the role of that investment for that individual in that company context, it goes a long way to protecting everyone's interests, I think.
I'm not being cheeky.
No, I kind of get...
I don't want to see Trevor cheeky.
Yeah, I can...
I understand what you're saying.
Yeah.
Angels are investing their own money. That's a big difference.
Yes, yeah, and individuals' careers are at stake by making poor decisions, and that's personal for them too. Yeah, it just shows up in a perverse set of, in a different way.
But I think it's a really, really good sort of conversation, because it means sort of going in eyes open. That's sort of one element of this, and that there's still the opportunity to act in the best interest of the company, regardless of this shareholding sort of nuances. And I think the good thing about the Flick deal is that there's another good shareholder still in the cap table, and that shareholding is not just valuable to Flick but also to the shareholding syndicate, as well as the exit had an opportunity for folks to retain a stake, which creates a sort of slightly different dynamic in the nature of the company. It's still a very entrepreneurial sort of feel about it. So I think there's clever ways of going in to improve that that path forward, but you do need to be conscious of what it might take to re-establish plan A if for whatever reason and that's what I've learnt from from having to disengage Vimeo and having to disengage AirAsia on Merlot is to have a means of having that conversation and to trigger an exit. So AirAsia exited basically through a negotiation, and they got their money back. Now, in the meantime, the company had raised money on substantial multiples, so they could have realistically said, look, it's now our 14% is worth a lot more. But really they saw that they didn't get the value to their business, rightly so, because we've gone down a different path. So I think going into a strategic investment, and Bruno's in the room here and he's got some scars and experience on various relationships of this nature. We've sort of run out of time, there he is, to talk that through, but to go and to try to protect those scenarios.